to this webinar, Real Estate Outlook Post-COVID 2019. You will see that in our poster we had said 2020. That was deliberate. Wanted to get all your attention. And I believe is that this pandemic will come to pass very soon in 2020. And then we can go back to by the grace of God. I'd like to welcome everybody once again. Our speakers are ready. And I'll just give you a brief introduction about the chamber, and then we'll roll. So the Nigeria-British Chamber of Commerce is the foremost bilateral chamber in Nigeria. It is made up of companies, Nigeria and from all over the world, are members of our chamber. The objective is to create a platform for business interaction amongst members of the chamber. We have specialized groups within the chamber. And one of the groups is the Construction and Real Estate Group, which is organizing this particular webinar. The group was specially created to cater for the needs of participants in the built environment. And membership of this group is open to contractors, civil engineering and services contractors, developers, consultants, architects, QSs, cost consultants, M&A consultants, and professional service providers. Any participant in the real estate platform for knowledge sharing about critical issues that affect. So once again, I'd like to thank you for joining us. The format is very simple. We have 4 speakers. I will just go ahead and introduce speakers now, starting with Andrea. Andrea is the CEO of Elalan Construction Group. We know Elalan is very famous for having done some very landmark development in Nigeria. They just finished number 4 Bodilon, and after number 4 Bodilon, I saw that recently they also commissioned the first phase of Blue Waters. He's been in Nigeria and he's got significant and considerable experience, which I believe he will be sharing with us today. Our next speaker is Paul Wanebe. Paul is the CEO, which is a group that traverses not just Nigeria, but has expanded into several parts of the world. And Paul led the expansion into America, into Europe, and in Africa. He's an architect, but he's gone met in Oniru, which is one of Paul's handiwork. So Paul will be sharing with us issues around mixed development and how this pandemic will have positive or negative impact on in that respect. Next is Funke Okubadejo. Funke is a graduate of the University of Lagos, chemical engineering, and also a chartered accountant. She's worked with Arthur Anderson, but today she's the Director of Real Estate for Actis. Actis, we know, have also made significant investments in Nigeria, particularly in retail and grade A office space. They also made a major acquisition in the hospitality industry about a year and a half or 2 years ago. So Funke brings significant knowledge and experience also to the table today. We'll be discussing with her issues around retail, the impact of the new customer behavior, consumer preferences, and things like that in the course of this webinar. Egi Apata. Egi is the Managing Director of Union Capital Markets Limited. Is a very, very regular commentator on significant economic issues in Nigeria. It brings to the table over 20-year investment banking, asset management, and securities trading experience to these and basically, what are we looking at in 2020? We're all very upbeat about the prospects of the real estate industry. Quite a number of favorable regulatory developments beginning from 2018. The new pioneer status legislation in 2019, the Finance Act, and quite a number of other developments have made really positive macro developments. Crash of interest rates, crash of yields on fixed instruments, made real estate to look a bit more attractive than it ever had been. Lenders began to look at real estate a bit more positively, and it appeared for the first time in about 10 years that real estate had a fighting chance to compete against other asset classes beyond our normal diversification argument that we always put on the table. But all that has changed now with COVID-19. And incidentally, in real estate, we always talk about externalities, but I'm not sure anybody will have imagined the kind of externalities which is coming about as a result of COVID-19. As a chamber, we also understand very clearly that the fortune of real estate is tied to the fortune of the economy, because real estate will thrive on the back of macro fundamentals. And that is why today we want to look at that nexus between the economy and the real estate sector so that we can make some projections, hopefully, based on the ability of us as a country to quickly flatten the curve and get back to normality as soon as possible. And to start the discussion, I'm going to be inviting Egi. At the beginning of this year, January, Egi was one of those that was very positive about real estate. And I remember that he said that there is perhaps no better time than now. So the new macro headwinds, the realities, and how that will affect the fortune of the industry going forward. We also like to talk about capital, cost of capital availability, and what you see as the chances of real estate in this context. Over to you, Eddie.
All right, thank you very much, Hakim. Thank you for inviting me to this event. I hope everybody can hear me. In terms of the macroeconomic situation we are dealing with now, yes, a lot has changed in the past 1 month. Some things are still the same, but the biggest one, which Hakim had mentioned, is the interest rate environment. If we run through a few key variables and the direction that things are moving now and how they'll most likely keep moving whenever this crisis ends, we'll see that it does have a bit of impact on the real estate sector. Inflation reports came out earlier this week from Nigerian-British Statistics, 12.26% year over year, slightly above the 12.2 before. Not particularly surprising, but I think it's clear that the trajectory is up. This is almost a 2-year high. And the question for the real estate sector is whether or not real estate is really an inflation hedge in Nigeria. I think the jury is still out on that. But what is clear is that a couple of variables are driving up costs, apart from dislocation in the supply chain due to restricted movement. The biggest one is the exchange rate environment, which again heavily impacts the real estate sector. GDP growth, the last report we have is really for 2019 Q4, which was at 2.55%, full year 2019, 2.27%. Clearly, with so many sectors shut down and with Lagos and Abuja and Ogun State locked down, it is very certain that we are in a negative GDP growth environment. How negative is the question? Since we don't have very real-time data like some other advanced countries. But if we see what has happened in the US in the past 1 month, where 22 million people filed for unemployment, I think we can get the picture as to the direction things are going. We don't really have unemployment data in Nigeria. The last report was 2016, and it was 23% at that time. I don't think you need to do a new report to know it's a lot worse now. The question is, how much worse has it gotten over the past 1 month? Because that eventually trickles down to a lot of landlords and the capacity for your tenants to pay. If they don't have jobs or they're not being paid or their industry is shut down, then it might become a problem. The biggest variable change in the environment right now is the exchange rate. And it's no surprise that the exchange rate is a big problem because Nigerian exchange rate more or less moves in line with the oil price. Unfortunately, anytime oil drops, the exchange rate falls off a cliff. When oil recovers, exchange rate doesn't recover. And I've never been able to understand that. That's why we are where we are now, coming from 52 kobo to $1 in 1981 to over 400 now. So the challenge on the exchange rate side again is that right now the official CBN rate for government business is 360. That number will move because the states and the federal government share money every month, heavily driven by dollars, and their nominal naira they receive needs to be above a certain level to pay salaries. So even though there was a move from 307 to 360, I strongly believe that number will move again. CBN has been kind of off work for the past month, so they are no more supplying BDCs. They're not even participating in the I&E window. Those are very important points because it means that the rate of depletion of reserves, which are now under 34 billion, that rate of depletion is actually much slower than it would normally be. CBN is pretty much shut down as far as FX is concerned right now. But when we look in the open market, what do we see? Parallel market for cash dollars are 425 right now. And transfer is at 450. Effectively, if you need to pay an invoice of any material amount offshore and you need to buy dollars in the open market, today you will pay 450 naira. Again, that's a big move in exchange rates because it effectively means that a lot of real estate inventory cannot be replaced at the historical price that it was quoted at because your import replacements are going to cost you a lot more in dollars. It does raise the very big question that I think a number of participants here will have to deal with. If you have debt or equity that is in foreign currency, or you have foreign currency rents, how much of a currency hedge is real estate in Nigeria? I think the data will suggest that it's a very poor hedge because it's too much of a task to ask that asset class to fight against the tide of devaluation. There are very few countries in the world where the real estate is quoted in foreign currency because it is a local asset. Interest rates, as Akim mentioned earlier, at the beginning of the year, we had interest rates so low that all of a sudden a 5% rental yield on a real estate property was looking like a fantastic deal. Those things are driven by distortions by CBN, which are quite extensive. Summary to say that when you have inflation at 12.2% and you have a one-year treasury bill at 4.5%, something is not right. And so over time, the market is going to force that distortion to normalize. And we see that in the bond market. For investments over 6 years, we're looking at 12% plus, and so clearly that one-year treasury bill rate of 4-point-something% is because Nigerian investors are not allowed into the OMO market. And so a lot of local investors have fled to the bond market. Again, from a competitive point of view, for real estate, can you compete with Naira nominal interest rates that have, on the long term, always been really above 12%? Moving average is probably about 13-14%. How do you compete with those kind of numbers? The real estate sector, if you look at the Nigerian Bureau of Statistics data for real estate GDP growth, real growth, it's been negative for years, suggesting that real estate activity has significantly slowed down over the past few years. And again, the question is, there might be some questions as to why that is happening, because a number of sectors are showing positive growth, but real estate sector has always showed negative growth up till the last report in 2019. Credit growth to the economy, the last CBN report suggested there was credit growth again. We should not assume that will continue, because what is clear from the credit markets is that the number of supposedly or previously very good credit counterparties are having problems with sales and getting money from clients. I mean, if you're a brewery company, for instance, or you're a restaurant business, a hotel business, clearly your business is almost shut down, and your ability to get credit going forward is going to be restricted. One other thing is, in terms of the way the Nigerian economy is structured with this monthly sharing of funds between various tiers of government. For March, FAC shared yesterday or the day before was at 780 billion, which is almost a year high. Again, most government finances things in Nigeria have a 3-month lag with oil. So the oil prices we are seeing now that are way below revised budget benchmark haven't yet hit the government system. And when they hit the government system, it will have some constraining effects on the economy, particularly places outside Lagos where the state governments are a very big variable in their economies. So I think with those variables, I think it's a bit clear that the challenge going forward for real estate becomes one, whether it's a competitive asset for a lot of investors, for those who are investors. And in this market, a big chunk of real estate activity is driven by investors, i.e. people who are investing in assets that are not their primary residence. But also for those who are primary buyers for occupation, the economic situation with the job losses and shutdown of some industries, how badly does it impact their ability to purchase these assets, or their credit quality for counterparties who want to take exposure, be it landlords or mortgage banks. I think with that, we have a bit of a picture as to what the macroeconomic situation is now and on the near term. I think the biggest challenge macro-wise for Nigeria is that government revenues have pretty much collapsed. To say they've shrunk will not be appropriate, meaning that for the federal and state governments to function, they pretty much are going to have to borrow most of what they spend just to operate. And in that environment, the amount of capex that can happen in the system and the trickle-down impact is questionable. So with that, I would like to hand it back to Hakeem and look forward to any further questions during this webinar. Thank you.
Hakeem, you're back online.
Hello?
Hakeem, you're on mute. Hello, Hakeem, you're on mute. I suspect.
Hello? Hello? Can you unmute me now?
Yeah, we can hear you.
We can hear you.
I can hear you now.
Thank you very much. Thank you very much. Because basically, COVID-19 presents very unique scenarios, customer confidence, new rules on new rules of behavior, social distancing, and things like that, you know. So what do you think? You know, and I'd like you to focus specifically on mixed developments, potential patronage. Are there any sweet spots, and what exactly do we need to do? Thank you, Paul.
Thank you, Hakeem, and thank you, the Nigerian-British Chamber of Commerce putting this together. I have to first of all say thank you, Eji, for giving me a sort of real education on the macros out here. So that sort of helped me sort of think about real estate in the larger sector. But I am one of those people that think that a lot has changed. The crisis we face now is unprecedented. It's unfolding rapidly. We have a multi-dimensional impact, and we yet understand what that multi-dimensional impact is. So with that, you know, I think we're living in some of the most turbulent and challenging times of our generation. In many ways, we're fortunate and unfortunate to be here at this sort of time. What it will help us do in real estate will help us rethink real estate to a very large degree, and maybe some of the old tried and tested means of delivering real estate will be questioned. You know, I think the world we live in has changed for good. I think the upheaval in the real estate sector will be defining. I think, as we all know, property is a platform for health, education, leisure, working, retail. And this is really a watershed moment in that I think each of those sectors will be challenged to the core. I think technology and lifestyle habits will change. I think when you look at the real estate, the different sectors, the office sector, I think, will become more remote. The retail sector will drift more online. The leisure sector will become more handheld. The industrial sector will be more technology driven. Education and health will be more DIY focused. I think lifestyle will evolve a lot more around the home than it will around work. I think by the time the tenants come back from 2, 3, 4, 5, 6 months off and working from home, and they get $1 million invoices on their desks, many of them will rethink as to how comfortable it was working from home against how comfortable it would be finding the multi-million dollar invoices, finding the money to pay the multi-million dollar invoices. So I must admit, I don't have many answers because we're still thinking it through, but there's some blue ocean strategy here. But perhaps maybe I can focus on 3 things: the short, the medium, and the long term. So I think in the short term, I think there will be supply chain difficulties. You know, as the regulatory environment stiffens, or let's just say the lockdown stiffens, there will be difficulties in whether it's supply chain, whether it's maintenance supply chain, and human resource supply chain. I think there'll be statutory issues because a lot of the statutory or regulatory part of what we do has literally vacated its seat. There are a number of things we were dealing with in Lagos and Nairobi simultaneously that are yet to be answered. So it's almost like life is on freeze and we'll have to start again when the doors are opened of government. In the medium term, real estate finance will become an issue. There'll be demand side issues. I mean, I think the property market was already quite soft before this happened. So we're yet to see what the effect on that is, especially the residential and the commercial property market being quite soft in the last year or two. We've barely recovered from the last 2 or 3 years before this has taken center stage. And then cash flow debt. I think every organization, every real estate organization will know that cash is king at this point in time. There'll be a number of clients that won't be able to pay their bills. There'll be a number of people who will be asking for concessions that we'll have to find ways to deal with. And in the long term, I've already hinted, there'll be many sector changes. I think there'll be a new norm, as people say. The way of life will change. Now, specifically on the sort of mixed use environment, I made the punt. I said lifestyle will evolve around the home and less at work. I think from a mixed use point of view, we're still trying to second guess what will happen. But from mixed use point of view, we think that the time has come, obviously, even though within those sectors of live, work and play, we'll need to make some adjustments. But I think there will be a bigger draw for people who could live, work and play in the same place. I think during this lockdown period would have taught a lot. I think there would need to be sort of more advances in technology, well, not technology, but in sustainability. So using buildings that are a lot more friendly, a lot more energy efficient. In terms of hygiene, there'll be an increase in hygiene, social distancing, decontaminating. So the way we design our buildings, the way we build our buildings, the way we manage our buildings will change to a large extent. We'll have to change to meet the sort of new demands. I remember when there have been other sort of blips that have changed the way the world thinks. Many people think it rolls back a few, once that disaster or so is over. And I remember September 11, and I was in New York at the time, and there were a lot of changes that happened in the world, especially in New York and America during that time. But even after that was long said and gone, some of the changes we witnessed there still work in our lives today. And I don't think this would be any different. I mean, this what's happening now, as I said, is unprecedented and hasn't happened before. So time will tell. one thing we are sure of within our sort of mixed-use environment, technology will have to play a much bigger role. I think when we look at sort of the advances in both infotech and biotech from the beginning, I mean, it's basically shaking the foundations of what thought was human. So just watching either different social media shows or TV shows during this period on technology advances, the time has come for the real estate industry to embrace some of that technology as well, and embrace some of those advances, and see how we can put those advances, make those advances give them to our own sort of good. So as I said, I don't have many answers at this point in time, because we're still doing the thinking and still sort of blue ocean thinking at this point. Oh, I see one of our questions that popped up on the screen. Yes.
Okay. Thank you, Paul. Once again, just to thank all the participants. Currently, we have 265 participants now who have joined us. Also to mention that we have some questions. We're trying to do some poll, and one of them we just like to encourage you to complete those polls so that they will help us in terms of what we want to do going forward. I come to you now, Funke, because part of what I think will come with COVID-19 is customer confidence, uncertainty. For real estate, uncertainty is not a very good friend of real estate at all. Retail and commercial, medium, short, and long term, And what we recommend as the strategy for players in this market at this time, is it to continue to build? Is it to hold? Is it to invest? What will be your prescription for players? Thank you.
Sure. Thank you, Hakeem, and thank you for organizing this, and good afternoon, everyone. I expect that you are staying safe and well wherever you are. And just to address the question directly, I think before going into that question, one way we like to look at real estate is looking at it in terms of the overall economy. So even though it's a sector in itself, it's actually a sector that reflects the overall economy itself. So when you're looking at the impact of real estate, you're really asking what's the impact on the economy? And there's not one answer in terms of what happens to real estate. So it is varied. I think if you look at the impact of COVID for some businesses, it actually has been quite positive. I think an example is the company that we're using, the Zoom network, where they've been able to increase their customer base by 400% in the first 1 month of COVID. That is also a potential real estate customer somewhere. There are other winners. Interesting enough, the grocery industry actually has been a winner globally. This is a very slow growing business generally, and it's been known that they are doing about 60% increase in volumes. Why? Because people are staying home, people are buying more grocery globally. So that said, things are going to be shaped, and as has been alluded to by other speakers, we're in a very dynamic situation right now, and you can't say, but what can we say right now in terms of what has happened? I think the most obvious ones are the industries that have been impacted, hospitality being one of them, with business travel grinding down to about less than 10% of what it was. The hotel hospitality businesses are suffering, and there's very little business traveling. There is also social distances that doesn't allow you to have meetings of more than 50 people, in some countries even 2 people, and where you found out that you found a number of hotels actually are closing, but you're finding some of them that are actually able to pivot their business and begin to offer services almost like a walking dormitory for critical workers in some markets. So this just to give an example in terms of how things will change. Right now, we're seeing retail also significantly affected because they're locked down. So generally for some people, we're basically seeing that their businesses are shut down and revenues have gone down to zero. Meanwhile, for some others, even when the lockdown is removed, you're going to find there's going to be a change in behavior. And the question that Hakeem asked is that, what will investors or property owners or developers do in this space? Want to build confidence back into the products that we offer to be able to meet their requirements. So this is begin to also understanding what are the key things that people will be looking for whenever they go into environments. They need to be sure about their safety. And I think Paul also spoke to the key things in terms of how do you deal with social distancing, how do you deal with hygiene factors that can ensure that people don't feel they will be exposed. I think one of the key things that people don't even really worry about is time in buildings, particularly in this area, is in terms of air quality. How are you sure that if you're in a building, they are injecting fresh air and you actually have fresh air in the building and you're just not recirculating the same air as well? So on a way, there's a lot of things that people who own property would have to think about in terms of how do they manage their building to ensure that they can give confidence. I think one viewpoint is also the fact that we live in a market where formal retail is just barely 5% of the retail that is going on. And to some extent, as people now begin to demand to be sure that they can stay safe while they're shopping, they most likely will be looking more towards the formal retail. So I think this is also something that would help in terms of formal retail. Moving on in terms of looking at this in terms of from an investment perspective, Hakeem said, what do we want to do at this time? Obviously, we have assets. We have to manage our assets through this period. And this is dealing with the challenges that we're going to have. One, in terms of the demand side, what is happening to some of our tenants in the building? For some people, the impact on their business has been severe, but it's not for everyone. And so things will have to be done on a case-by-case basis for the different tenants and the ones that have been impacted. So for instance, we have a mall in which about 50% of the GLA is still trading. So, because they are classified as essential services. So they're actually trading quite well in this period, while other people are locked down because they're deemed to be non-essential. So there'll be a way where we would, some workout that will need to be done because there's going to be impact on cash flows for the assets. And likewise, because a lot of these assets are carrying debt, the conversations also happening with the lenders in terms of determining what type of forbearance can be provided to the property to be able to ride out what hopefully is a shorter period. And we're taking a 3 to 6 month view in the first instance of the time or period in which the assets will be severely impacted. But if I go on in terms of what is really our appetite to buy assets or to continue to invest in this climate, I think really it's about looking at what is the long-term prospects and what do we really see as the drivers for investment opportunities. Those drivers haven't changed. It's essentially urbanization, and it's essentially the demography and population that is driving. Ige spoke about the macro. We've all, prior to the COVID, there had been macro challenges. There had been need for key reforms to happen. The interesting thing is that it does look like the federal government is not wasting the opportunity. And they have made several promulgations of things that are significant changes or implementation of key policies, removal of subsidy, the single exchange rates. But this you still don't get the full confidence that this have been properly structured and it will not be just the knee-jerk reaction from COVID. So for instance, we expect the IEFX to be able to move the exchange rate until it is liquid. So we shouldn't have a situation where you can get a higher rate on the parallel market than the IEFX market, because we expect that to be liquid, because that is what investors are looking for, to be able to bring in their money and exchange it knowing there's a liquid market in there. So I think for us, what will give confidence if there are movements on these areas. And I think in looking at what areas would we want to invest in, or what types of opportunities we would like to invest in, I think we'll definitely be looking more in terms of saying, there are a number of investments that have been done over the last, say, 5 to 10 years in the market. There are opportunities to create a different asset class as well, which will be in terms of looking at stabilized income yielding vehicle vis-a-vis for us to continue to invest in greenfield ground-up developments. And there's also opportunities to look at brownfields, investing in existing properties rather than just continue to look at a greenfield. Essentially, what determines what you need to invest in is essentially demand and supply gap. So we will continue to look at that in determining what asset or subclasses that we invest in. I think there's a new survey question, so I come back to you, Hakeem.
All right, thank you very much. I'll go to Andrea now. Clearly, Andrea, and I'd just like to share your thoughts with us on what you think is the immediate, medium, and long-term impact of COVID-19. What are the impacts? What will be the impact on current developments? What will be the impact on supply chain? I mean, people have mentioned supply chain disruption. How do you see that really affecting the industry going forward?
Okay. Thank you, Hakeem. Thanks for inviting me on this. And look, this is totally uncharted territory. There's no need for me to repeat it. Nobody has ever gone through periods like this. We'd started the year on a good note. Things were picking up. We had a full pipeline of projects. Demand was picking up all over the place. And we were starting to recover from the brutal recession we had gone through the last 3 years or so. And we were very optimistic. Unfortunately, this COVID thing happened, and now everything has gone to the soft one, and there's a hard one. Whether reset or a hard reset, we will find out. I mean, we're definitely going in a recession. And how long it's going to be, not sure. But anyway, China is picking up. They've started producing again. So let's see how far that goes. Maybe something, but the effect of the COVID itself, it is more the oil price that has effect. COVID, yes, restrictions of movement, rethinking of design and stuff like that, but it is really the effect on the forex that affects us more than anything else. We don't know how that's going to go. I had a meeting with a client this morning, and they were asking us to reduce for a service contract. They were asking us to reduce our prices by 30%. So major oil companies, and that is definitely not. So the effects we really don't know. But in the sector we're working in, which is really the premium residential real estate, we are working really in two ends. One is the, let us say, super high luxury, and the other one is the medium kind of affordable luxury that we like to call. So the effects on the high-end luxury will just be a delay. People will just wait and see what happens. I don't think it will put them off buying, because most of our clients, and we position our products in the high end for the owner occupier, not for the investor. So the people who buy into our developments buy to live in. They're not thinking of returns, of yields, of alternative investments. It is either a main residence or a secondary residence. So a lot of our clients would be first buyers who live abroad and they need somewhere to live in Nigeria, or they are just changing from living in a house or in a townhouse to a serviced luxury building. So I think the effect of the COVID and the Forex will just delay this. It will not erode it, it will not kill it. The developments that will be more directly affected are the medium end. This would be for the people who are earning Naira and they're looking to buy their first home or something. It will be a smaller kind of flat, 2 beds, 3 beds. This will definitely be negatively affected. It may delay it, it may stop it for some time. And now it depends how long that is going to take, I don't know. But there are two scenarios. There's a worst case scenario and the best case scenario. Best case scenario is that we go into that recession and it bounces back and it's like, okay, we've lost 2-3 months of production, of sales, of everything, and we are restarting again. Oil prices go up again to whatever they were before and things take back. The worst case scenario is that if this COVID thing drags on and we have other infections and then the oil market doesn't recover and the production doesn't recover, this will be catastrophic for us. The construction industry will be highly affected because most people are not working now. They're debating whether to pay salaries or not to pay salaries for the months of April. It will end up of payment maybe of a partial salary, but for the following months, they may have to lay off people, and this will be really, really, really very bad. We're counting on government stimulus to come in and to help out. In most countries, this has happened. In France, they are paying, if you send your people home on not a layoff, but on a extended leave, you pay them 70% of your salary and the government reimburses you the 70%. So the policy is no business will go down no matter what happens. In the UK, they have similar schemes. The US, in Nigeria, we haven't yet heard of anything. We've approached government for support because the construction industry, obviously, I mean, is one of the, like what Funke said, I mean, is really, really an important part of the whole, I mean, so we'll have to wait and see what happens. But again, as with all recessions and all problems, there are opportunities because now is really the best time. If you have cash, this would be the best time to start on a new project. Whether it's residential offices, I'm not sure, because the whole office space now is being rethought, as in terms of the distancing, the social distancing. Funke mentioned the ventilation system. They really don't know yet whether COVID is spread through air conditioning or not, but it looks like it is, because most of the cruise ships have had these issues, and they're saying it's not just by direct contact, it can be in the air. So this may have a really deep effect on the office design and the office development space as a whole. On the residential, I think people will still need homes, they will still need houses. Nothing is going to change, it's just going to be delayed. And the prices obviously are totally linked to the Forex, to the Naira Forex, to the Naira dollar rate. So prices in Naira are definitely going to increase. Not in line, but like the last time, it will be maybe 60% of the increase in this. But again, it's an opportunity. If anybody has cash today, this would be one of the best times to invest, because people need cash. prices would go down. You'll have a lot of distressed sales for people to survive in their businesses. They may be wanting to sell their properties, their land, and so on and so forth. And interest rates is definitely key. If if the interest rates remain low, then this will be another factor that's a good factor for the property market as a whole. So yeah, that is my view on the issue.
Thank you, Andrea, and thank you all our speakers for this first round of contributions. Let me mention quickly to all our participants, we already have 300 people now listening to us. Please help us to complete the poll that I think we've sent out 4 questions. Please help us to complete so that we can also give you a feedback on what are the responses that we get from the poll. Let me also mention, since we have a lot of on ground now, that this webinar is organized by the Construction and Real Estate Group of the Nigerian-British Chamber of Commerce. We're a bilateral chamber. Our group is open to all the participants in the real estate value chain. So at the end of this webinar, the secretary will display the contact of the membership officer, and we'd like you to please come and join us and let's push our agenda forward. I mean, I've seen quite a number of questions, you know, and a whole lot of them have bordered around the lower end of the residential market. You know, let me just chip in before I go back to you, Paul, and then Eddie. Let me just add to what Andrea said, that if you play below that medium level, there are 4 things that I think should worry you now. Number 1, you should worry about your supply chain, because there'll be a whole lot of supply chain disruption. 25% of, more than that, 70% of our inputs are imported, and about 25-30% comes from China. You know, so there'll be a lot of disruption in inputs to your development. You must worry about your customers, because just like we have had Andrea said, at that level, people are a lot more worried about survival and staying afloat, you know, and people also don't take real estate decisions at that level when there's so much uncertainty in the market. You worry about your project delivery, because obviously with the pipeline disruption, I've seen questions around force majeure, which we will undo at the end of the program. And then if you have debt, you should be worried. You should be worried about your gearing. You know, I must be thinking of how to quickly bring in cash, like Funke said, at least to offload, to offset those debts in the medium to long term. Come back to you, Paul, because you've had significant experience raising funding, which you have used to grow Landmark. What do you think will be the attitude of capital providers in the era that we are entering? What do you think will be the perspective of capital providers in this era?
Yeah, well, that's a tough question. So I suppose there are 2 things that could happen or that are happening now. One is obviously people are going back to their capital providers and having discussions just because of the unprecedented nature and the sort of rapidly unfolding story this pandemic is telling. So those conversations, and you know, we're no strangers to this, and that we're having conversations as well. And those conversations, most capital providers, if they're impact fund related, you know, are sympathetic towards it. If they're not impact fund related, they're not so sympathetic because they have their own return metrics that they have to meet. In terms of new capital, so I mean, that's an interesting one. Whether, and I'm probably the wrong person to ask, whether financial institutions will engage in conversations at this point in time with regards to new capital in the real estate industry at a time when effectively all sectors apart from residential, or almost all sectors apart from residential, are at a standstill. So that will be interesting. I suppose Funke will probably be in a better position to give a direct view on that. But I suppose, well, the maybe 4 or 5 things that's our opportunities. And I think one of us mentioned that there, as well as the threats, there's certain opportunities in the real estate industry now. Yes, supply chain may be difficult, but assets will come at cheaper prices. There will be bargain hunters. There is an opportunity to introduce more sustainability. There's an opportunity to review our real estate in a big way. And some of the fundamentals are still very strong. So the demand side fundamentals for a whole range of the sectors is still quite good, and that's something that should be pushed because of the favorable demographics. I can't imagine there'll be much money around after this pandemic ends, and I don't think this pandemic will or the effects of this pandemic won't end after the lockdown. It will end many months, if not years after. So it's time will tell. Obviously, the regulator will play a big role as well in terms of what sort of concessions and what sort of palliative and policies that will bring for the real estate industry. I mean, so far I've seen things like tax delays, but they didn't even begin to go far enough. I mean, we need to protect employment, we need to protect the supply chain, we need to get people back to work, at least in the construction industry. I know that was one of the questions. I mean, every square meter of building employs 3 people directly, I'm told, and 11 people indirectly. So if you did the numbers, I mean, we halted a 75,000 square meter hotel project because of this. I mean, that alone has cost 225 direct employees their jobs, and obviously 750 indirect employees. So how the sort of the finance or the funding sector will look at it and how patient it will be, time will tell.
Okay, thank you, Paul. I'm coming back to you, Funke. I'm basically along the same line of thought. One of the things I've seen is people are saying that perhaps it is time also for the real estate sector in Nigeria to begin to look at alternative real estate asset classes that so far we've all concentrated on the same pool of assets, commercial, residential, and retail. So it's been said that maybe it's time for us to begin to look at, for example, I read that in the UK now, even during this pandemic, that the demand for student housing has gone up. And people are also saying that with the focus on healthcare and related issues in Nigeria, maybe it's time to start looking at healthcare assets and things like that. I don't know whether you think those are sweet spots which we can be looking at, and what other sweet spots do you see for the industry?
Sure. I think, like I said, when you're looking at real estate and demand, you just don't. It should be based on demand. It's not just people want to have their office building. I know there's some developers who start with the whole idea of just owning without any information in terms of what is actually driving and is there actually demand for that product. So I think that really is what investors will look at. That said, why haven't, and so the question would have been, why haven't people invested in those sectors previously? And maybe now there's an impetus to do that with the government now beginning to really focus on making investment, let's say in the healthcare sector. So you have a lot of fragmented hospitals, and there's no scale hospital who you can work with and say you want to build a 10,000 square meter building. That said, there are a couple of projects that I know that are ongoing, and then there may be an opportunity wherein an investor can come and invest on the property side and allow the group really just focus on building out a health service operating company. So I think that's something that will come. I think that's also something that will speak very well to impact investors who Paul mentioned. So these are typically DFIs who are looking to make investments in areas where there hasn't been any real supply up to date. For student housing, I think I've heard people even call it youth housing, which means you're really not just targeting students, you're targeting people just finishing school, 1 or 2 years of experience. They want to live in urban areas. They don't want to be too far out, and they're happy to be in a studio or in a one-bed apartment or an apartment sharing scheme. So I think I'm beginning to hear that some of these products may come over time. But in terms of scale, that's where an investor like Actis finds it difficult to participate because they are still quite nascent and thus wouldn't attract too much capital at this point.
Okay, Eggy, I'm coming back to you, Eggy, because as a commentator and as somebody who's very interested in the industry, what do you see as sweet spots? Or like I said, is it all doom or are there prospects? Based on the macro situation that you have painted.
Yeah, thank you, Hakeem. I think looking at what will happen 6 months and above from now is a bit different from the mood that we are in now. So I think one will have to bear that in mind. So clearly, the current situation is very hard to predict, both from the point of view of the oil price, the exchange rate, unemployment, and a whole bunch of variables. But when the dust settles, clearly some behaviors will change. I think where the sweet spot is, again, talking within the local Nigerian market, is for just lower price point assets. And I mean, things that are more geared towards where the median Nigerian population sits, rather than things that are geared towards where just a handful of very rich people are. And the reason why I say that is that if you go back to look at, people have talked about other asset classes. There are 3 REITs listed on Nigerian Stock Exchange. None of them has gone up in value in the past 7 years. They're all down substantially in the past 7 to 12 years, and that's in Naira. Part of the challenge they had was that they're holding high-end assets who tend to correct very rapidly in an unstable situation. And one thing we are sure of in Nigeria is that the currency will routinely fall off a cliff. It's been doing that for the past 40 years, and it will continue to do that. So price point becomes key, price per square meter rent, price per unit, price per whatever, much lower levels, and where there's a lot more demand that can remain when the easy money is taken out of the economy, like periods like now. Also, for on the investment side, people bringing things to the market need to be aware that there is competition. One thing that has happened over the past several years in this market is that a lot of assets classes that were once exclusively for HNIs and institutions have been democratized, be it government instruments that pay very well, be it Eurobonds that are dollar instruments that as of today are yielding about 15% in dollars. Those have been democratized and are now very heavy competition for the real estate asset class. It's no more good enough to use emotion to sell real estate. You need to use facts and you have to compete. But I think that, if those 2 things are done, price point and be competitive with other asset classes, I think that the market will readjust itself to the new realities, and there will be significant opportunities in the future. The population is there. People have to stay somewhere. The key is to work backwards from the answer. What can people afford? Where do they want to stay? What kind of things do they want to stay in? And provide that on a scalable basis. So that's what I think the opportunity is going forward. Unfortunately, for people who are very exposed in the upper end of the market, it might be a while before the system readjusts to absorb that product. But again, the challenge in this environment is that when you have the step downs in exchange rates, it's very difficult for the asset classes to move in lockstep because purchasing power doesn't move up as fast. Thank you.
Okay. Let me go to Q&A now. There are some specific questions which have been asked. Andrea, this question is that, Andrea, are you listening to me? There are questions for Andrea. There's questions for everybody, actually. Andrea, this question is directly, specifically at you. That you said something about this is the best moment to invest. Are you talking about investing in oil, or are you just talking about real estate? Which element has the best chances? All of these have almost the same probability of profits. I don't know whether you understand the question. That's the question.
No. Obviously, it is. I'm just referring to real estate. Obviously, I mean, I'm not, oil is not. Real estate is really my my bread and butter. So I'm not into oil. Yes, obviously, because you have forced sales now. Land prices are half what they should be. They just need cash. You have properties that are going for half of what they cost, that are for sale. Again, all depending on cash and so on and so forth. So if anybody has cash today, this is really a good time to come into the market. COVID or no COVID, I don't think the prices can go much lower than that. These are the opportunities. Interest rates are low. If you borrow in Naira at a low interest rate and Naira is devalued, then you have a really very cheap proposition. So, but the thing is that one needs that cash to do that.
Okay, thank you very much. I have a question for you, Paul, on the issue of mixed development, which you have alluded to, which I know is what you do. So I have a question here that post COVID-19, how do you see that going forward? Do you see it becoming a key focus area for real estate? Do you think it's going to be profitable? And do you advise investors to look at that particular area going forward?
Yes, I think the simple answer is yes. I think as I said, lifestyle will change, a lot of habits, and the way we approach real estate will change. I think what COVID has taught us is that different ways to work, the different ways to play, the different ways to basically, to exist. So I would say that the mixed-use platform will be a great platform going forward, so long as you can tick a number of boxes. One of the boxes is just the comfort of living and working in the same sort of environment. Another box is just the shortness to retail. So where you have situations where there's either a lockdown or restrictions of movement, you can still access goods and services relatively easily, at least those limited goods and services. In a mixed-use environment, special attention is made by developers to things like social distance and technology, ease of transportation, security. So some of those issues, you find a lot more acceptable in mixed-use development. Then, post COVID-19, there were traditional advantages mixed-use development brought. One was, you don't get involved in traffic, so that ability to live, work, and play in the same place, and that ability to earn, from a developer's perspective as well, that ability to earn sort of multiple revenue streams from different facets of your business. So you never really hit in one place at one time. I mean, we as hosts to mixed-use development here, we've felt some of the impact for the simple reason that a lot of our mixed-use development is lifestyle-based. So you can imagine all our retail shops are closed, our food and beverage outlets are closed, our beach is closed, the hotel was shut down. So the only thing operational basically is the offices, and there's nobody in it. But you still have to run it because of service. But if we had a sort of denser residential element to our mixed-use development, I think one of the priority places to be, just for the simple fact that you, as a community, can access so many things at the same time. So technology will play a big part as well. So I think as we begin to develop more and more mixed-use developments, I think it's important to incorporate technology so the future can be incorporated too.
Okay, thank you. Okay, I'll go to specific questions now. Eggy, somebody is wondering why our currency is just still falling at this time. And they're also asking whether what do you think will be the exchange rate by the end of the year? The magic box you can, what would be likely dollar by year?
I think the question of where the exchange rate will be is a very difficult one to answer. A number of different people have put things out there. In terms of why the currency is falling to start with, again, Nigerian currency has always historically tracked the oil market, and when oil crashes, Naira crashes with it, but never recovers. Not particularly odd for a quasi-market-driven currency for that to happen to it. I mean, Canadian dollar is partly a petro currency. 2008, the Canadian dollar was at par with the US dollar. Today is 1.42. So you do have movement currency. The Middle Eastern countries tend to have fixed pegs, the Gulf countries, so that's why their currencies don't move as much. There are a couple of proxies we can use to try and figure out where things will be by year end. I mean, the 1 year forward offshore is already at 500, and clearly that's an offshore. In terms of on the local side, as I said, the transfer rate for inflow or transfer dollars that you can move around by wire is already at 450. Now, many of the problems with the oil price are yet to show up on the financials of the CBN or the government of Nigeria. So by the time you start seeing the impact of oil below $20 in the system, it's very hard to see how the exchange rate can improve. The only way out is if there's a huge amount of money borrowed from offshore by the Nigerian government. Let's talk about $6.9 billion from IMF, World Bank, AFDB. That amount of money seems large when you convert to Naira, but in terms of foreign exchange use of Nigeria, it's actually relatively small. So if that is all that is done between now and year end, I think it's safe to assume that what you see in the offshore forward market will become a reality in parts of the market. Bear in mind, you have official market, INE, and a whole bunch of other things in between. But for the average person on the streets, the free market is what you should be looking at. And that forward, offshore forward rate of 500 plus is probably relatively accurate as to where things are going. But almost every time it always overshoots. So when Naira crashes, it overshoots in one side, and people who go in at that time could get burnt. I mean, in 2017, on the black market, Naira got to 525. If you change money at that time, you haven't recovered because it fell all the way from 525 back to 360. So people should also be careful how they speculate. Thank you.
Okay, thank you. I guess Funke should help us with this question. There's people are worried that with the new social distancing rules, it becomes difficult, for example, to do property inspections with agents and things like that. What will be your advice on how to go about this in the new dispensation?
I think definitely there will be a new normal in terms of how we interact on social distancing and how we can all keep ourselves safe with the social interactions that we all most certainly have to have. So one way of thinking about it is that, the people who are infected, the people who are working there on a daily basis, treating them, cleaning, taking care of them. And while some have succumbed, unfortunately, the great majority are being able to stay safe. So I believe that, people will get informed in terms of what they need to do. And I think that's the guidance that we'll be expecting from our healthcare officials to say, as the lockdown is being released in many countries, and we also have seen, countries very close to China who were part of the initial infection rates and have continued to operate, so South Korea. So I don't think that this means that, we will have to stay in isolation until the last COVID case is eradicated. And there's definitely ways in which we will stay safe. And I think for property owners generally, you have to be providing a more visible means to give confidence to people that they will stay safe and secure. So doing things like temperature checks, ensuring you're giving people hand sanitizers, ensuring you're spacing things out and making sure people are not staying too close to each other. So my sincere belief is that we can still operate, and a number of people in the essential services continue to operate with taking precautions.
I guess that a lot of inspections can also be done online now with virtual reality, augmented reality, and things like that. There's somebody who has asked you a specific question, Funke, trying to put on the spot, that what kind of IRR will parties looking at before they can invest on the kinds that you have spoken of earlier? What kind of IRR?
And so for this type of projects, so your IRR expectation is actually a function of your investor expectation. So when you're looking at impact returns are generally more longer dated, and as a result of being longer dated, typically will be lower than the typical sort of opportunistic investor. So in terms of ranges, so that it doesn't seem like I don't want to answer the question specifically, while you would be looking at above 20% return for opportunistic range, you would be at the lower teens for a kind of impact focused fund.
Okay, I want us to discuss specifically about the policy response, but as it relates to the real estate sector, and I want us to look at it from two perspectives. The kind of stimulus which Andrea already spoke about. We know that CBN already has a 50 billion naira fund, but that's just like a drop in the ocean. And also, unfortunately, real estate is not specifically mentioned as one of the industries that could benefit from that fund, although there's an omnibus section on all other businesses. So maybe if you're a real estate player, you could fall under that. I mean, but really, it's not anything major because we're talking of supports of between 3 million and 25 million naira. And I get that for small businesses, 25 million naira may be a very good cushion for working capital for a few months at this particular time. But I want us to look at what are the kind of policy responses will we expect to see from government in terms of helping to ensure that this sector, remains where it should be, because clearly this sector is a very strong nexus. If you're talking of economic prosperity, you have to look at real estate, you have to look at construction. Construction creates jobs easily. I always tell people that when you look at any construction site, you see an ecosystem on its own. You see consultants, you see contractors, you see food vendors, you see daily paid laborers, So there's an ecosystem, that comes out of every construction site, So what kind of support would you like to see from government to ensure that we remain in business? I don't know whether Andrea and Paul want to answer that. Yeah, Andrea? Okay, Paul, you can go ahead. You can go first.
Okay, no, thank you very much. So I suppose I can think of a number of ways, and not all of them are direct government, but some of them are sort of government enabled. So one I can think of, obviously, is government control over the central bank and over banks. Yes. At this point in time, I can imagine lots of real estate construction companies have exposures, and without any income, they're under pressure to meet some of those exposures. So I would say concessions, interest concessions, holidays, extended moratoriums, extended repayments will help. I would think that from a tax point of view as well, this government has been particularly aggressive on taxes. I would say that tax concessions or extensions would help. I think some of the things the government has been talking about as well with regards to power, it's a period where many people are staying at home. I think trying to create more power, ensuring that more homes have more power available, and ensuring that it's either cheap or free is important. I think, like many other countries, one of the biggest areas affected is employment. So people generally, and obviously the construction sector makes up a lot of people, a lot of casual labor as well. The property development sector makes up a lot too. I mean, we had over 290 people that unfortunately were unable to retain in our books just in the sort of leisure sector of our business. So, and some governments have come up with some packages that help pay some of the salaries of these people to effectively keep them in jobs. So I can imagine those are some from a braver standpoint of trying to get people back to work. How it remains to be seen how they will arrive in the sector and how they will release people generally back into work. I mean, it could be irresponsible just to say open up and everybody get on the streets, and who knows what will happen then. But I think some jobs are easier to release in than others, and just being fundamentally thoughtful about it and using wisdom to do that, I think, is important.
Okay, thank you, Andrea. You want to add to that, and then Funke also.
Yes, actually, there are several ways they can help out. In the short term, I think it is of fundamental importance that they help out the construction industry and therefore the property development market and so on and so forth. They should absolutely try to avoid layoffs and business closures. So they need to support that either by subsidizing outright payment of subsidy for payment of salaries, or giving interest-free or super low interest loans that can be repaid over a period of 4 or 5 years for people not to lay off their workforce. That needs to be done in order to avoid layoffs. Layoffs would be the worst thing that can happen to the industry and to the nation as a whole. A lot of people in the construction industry are daily paid, and if they don't work, they don't get paid. That would be catastrophic in all aspects. In the short term, this has to be done. In the longer term, to support the industry, then the mortgage industry has to be developed. We need to see mortgages in single figures for first-time buyers, for people like that. Land concessions, prices on land, government, land grants, and so on and so forth. That would be the longer-term thing. But for sure, in the shorter term, cash support has to come in somehow, whether it's in tax concessions, whether it is in salary subsidies, whether it is in interest-free loans. The construction industry cannot survive, and they can maybe take 1 month, but the next month they will have to fold up. They can't. They will have to lay off people. Nobody can sustain businesses without production, without getting paid. So yeah.
Okay, Funke, what are your thoughts on that?
Yeah, I think one thing they've done which helps is the forbearance, which is saying that allowing banks to restructure. I think that's been important for cash flow and liquidity for businesses. Unfortunately, that doesn't cover all loans if it's off balance sheet from the banks, but I think that's one way. And if there's more direct credit, like you said, 50 billion is such a small drop in what is needed. And when you look at the scale of the level of stimulus that the advanced countries are doing, that have better infrastructure to even support themselves in this downturn, it gives you a sense of the level of challenge that is needed to actually support the overall economy itself. So whatever can be done in terms of stimulus, in terms of projects, I think one thing that could be deemed like a stimulus is that Nigeria is a place where people see a lot of opportunity, but is a lack of reform, and that has almost slowed down the FDI to all-time lows. For I think last year, for the first time, Ghana had much more FDI than Nigeria. So this is really the time to focus on some of the reforms that can unlock new opportunities. The only one example we continue to have is the telecom reforms and how much capital that brought into the country. The electricity reforms were not done as well. It didn't really bring any foreign direct investment. It just put a lot of debt on the banks, and they're probably one of the problems the banking industry has in terms of non-performing loans. But if you can restructure the reforms, I'm almost certain that there's so much capital that can be attracted for investment in Nigeria. Nigeria is a very attractive country for investment, for growth, because of the youthful population and the opportunity if we can exploit it. So, sitting down so many years, we continue to talk about potential and not exactly how it can be exploited. I will say that we look at the plan and the implementation plan, or the plans that the government put out like 3.5 years ago, the economic recovery and growth plans. On paper, it's perfect. Will they do it? Now it looks like we don't have a choice. They have to do something. And I'm really hoping that they'll get it done. So they've moved on some things, but not in the manner that you want it to be done, where it is backed by law. So we are certain that as it was announced in a casual manner, it cannot be unwound because it's been done before.
Okay, thank you. Do you also want to, I'm sure you've taken a look at the policy response. What else do you think?
Thank you, Hakeem. Yeah, I think the challenge that when you look at the policy or the government responses, if you look at the US as an example, I mean, the scale of money that on the fiscal side is well over 10% of GDP. And that's ignoring what the Federal Reserve has done, which is well over $1 trillion. But I think the challenge is to understand that the Nigerian government at all levels are very, very small relative to GDP in Nigeria. The government is really small. And so the government's resources are extremely limited. I mean, right now, it's very safe to say that most of the salaries at the government level are being funded with borrowed money. Forget capital expenditure. And so the government has very limited capacity to do much without causing a huge amount of inflation. Central bank has more or less stepped in to do what government should be doing. But again, the central bank's focus is very limited. They try to, on paper, go where the numbers are. And in terms of number of people who are in an industry, they have the most people in agriculture, which is why they throw money at that industry. So I think one thing that would help the real estate sector in the future, obviously is not possible now, is in terms of having a much larger number of people in this asset class. So the reason why in the US, for instance, the Federal Reserve will be buying up mortgage-backed securities to push down interest rates so people could borrow to refinance mortgages cheaper or buy houses is because 70% of the population own their own homes. That's not the case here. So if you have a situation where 70% of your population is involved in something, either they own homes or they have mortgages or things around that, and there's a problem in that sector, the government simply has to do something. So I get the impression in the Nigerian environment, the government sees the real estate sector largely a rich person sector, and because at the end of the day, the number of people at the bottom of the pyramid are very few. Number of mortgages are very few, and there's really not much impact as far as government is concerned. In terms of the issue of giving out money, again, we've not really seen much on the fiscal side. Everything is all CBN announcements, it's refinancing, there's a few sectors that very few people have access to. And again, it probably will not amount to much without the government taking on a huge amount of debt. Right now, all the debt they're taking on is just to pay their operating costs. So I think going forward, two things: the real estate sector has to democratize, more people have to be owners, and two, it has to borrow a lot more. The reality is that if a sector is 40% of the bank balance sheets in Nigeria, the government will support it. But right now, the number of people who, or the size of bank balance sheets in direct real estate lending is very small, and so it's not really seen as something that could pretty much put the economy in a tailspin if it's not resolved. Thank you.
Okay, thank you. I mean, we have so many questions. Unfortunately, we have just like 5-6 minutes to round up. So what I'm going to say to those who have sent in those questions is that we're going to do direct answers to them, but we really need to start closing now. And what I'm just going to do is to go around all our speakers to just give like their final notes or comment on the issues around real estate and how they still. And particularly, there are a lot of players who are asking questions about force majeure. How do you deal with the question of delay and things like that? Maybe we want to just take that as we round up. And I'm going to start with you, Paul.
Thank you, Hakeem. Well, a lot has been said, and I suppose at the top of the conversation, my first salvo was, we're in a crisis. It's unfolding rapidly. We're still yet to determine where to come and what we're yet to understand in multidimensional impact. But one thing we can say, just listening to all the speakers today, is that there are issues to solve, short, medium, and long term, and the opportunities to be had. So from our point of view as a developer and as a mixed-use developer, I would say the first issue to solve is just to make our developments a lot more attractive, a lot more technology-enabled, a lot more compliant with hygiene standards and social distancing standards and what the future may hold. The second thing is to back up our tenants and our stakeholders in such a way that we find ways to not only give the tenants breaks, but to ensure that when they come back to business, and their businesses are stronger for it and can rely on more logistics and backing that we can provide as an organization. And thirdly is to play our role by reaching out to government and other sectors to ensure that the industry we're in, yes, is watched and taken care of. Because as some of the speakers have said, a lot of the palliative care coming out from government or the CBN, none of them are really specifically honed in on real estate. And with the tumbling Naira-dollar relationship and the crumbling supply chain and the difficulties of bringing things in, I think the construction industry is under threat, and the development industry is under threat. So time is now for us to begin to work on it.
Thank you, Paul. Funke, any?
Yeah, I think for us, it's really to ensure we understand what's happening and, liaise with our different stakeholders. And I think, as we said, this is a crisis. It's unfolding. I don't think there's significant reliance on saying what are my legal positions at this point. I think we've all realized that it's all in our best interest to collaborate and to have, each party try and see how you can ride out what the storm is. As the storm is riding out, I think we also have to be quite vigilant to understand, what is going to be the new normal. How do we respond to how we're going to live over the next, as people are beginning to prepare us over the next sort of 12 to 18 months and maybe even beyond? How would that impact our businesses? And at the same time, there are a lot of opportunities in terms of how you have to pivot from some of your existing businesses and look at what the opportunities and how do you change some of the services that you offer to be able to respond to the times that you are in right now. Thank you very much, and stay safe and stay well.
Thank you. Andrea, any last comment?
Maybe a positive comment. I mean, we've gone through crises before, and Nigeria has always managed to survive. I've always believed in a Nigerian factor that kicks in somehow and saves the situation. So maybe this is what we would be looking for now. There are opportunities that are coming up, new models. We just have to wait. We need to manage our cash flows, save our workforce as much as possible, and try to last as long as possible until we're out of the crisis. But eventually, things will pick up.
On that note, we are out of time, essentially. First of all, let me thank our speakers, Egi, Andrea, and Paul, and Funke. Thank you for sharing your thoughts with us. And also thank all those who have joined us this afternoon. We started with over 300, and we still have 286 people at this time who are still logged on. We thank you so very much. Once again, you can see the email of the chamber on our screen now, particularly for those who are in the built environment. We'd like you to join us. On a final word from me, I mean, we cannot overstress the fact that we're in a crisis. We have to be very circumspect. We cannot just take opportunistic decisions. And this is not just for real estate, for every segment at this particular time, But that model is an incurable optimist. I believe that we should stay focused on our industry. We should be less adversarial, in dealing with the issues that will arise. Clearly, there will be a lot of construction disputes, delays, payments have been made, guarantees to be called and things like that. I think this is the time, because we've all been foisted with a fait accompli that nobody will have expected. I think this is not the time to be adversarial. This is a time to be cooperative. This is a time to be understanding. This is a time to both sit down and look at all the issues together. And also hoping that some of the suggestions that we have made to government will take them on board. I think government has to be a lot more responsive. All the structural issues that we've always had around real estate, this is the time for government to really go the extra mile to help us deal with those structural problems. We are all moving into the era of digitization. Government also, in terms of e-approvals and all those things, nobody wants to go and start sitting in any government office chasing approval. All those things should be brought online. And we hope that hopefully, I like what Andrea said, that the Nigerian factor, and with God on our side, we'll flatten the curve. I've read that COVID will mean a change of our lives, but not an end of our lives. So let's all keep safe. Let's keep well. Hopefully, very soon we'll meet again and we'll rejoice. Thank you very much for listening to us. I wish you all the best. We'll collate. This session has been recorded. We'll put it on our website. You can have access to it. Web TV is also monitoring. It's also going to be on the platform of Web TV and other platforms like that. Thank you very much. God bless you. Thanks. I think we can